Hi, I'm Igor, and welcome to Wealth Chronicles. Let me ask you something. Have you ever wanted to invest, but the idea just felt terrifying? Like the market's this wild beast that could eat your money alive? Well, you're not alone. Today, I'm going to talk about risk tolerance, what it really means, why you're probably more risk-averse than you need to be, and how that changes once you understand how money and markets actually work. But before we continue, if you think videos such as this bring value to you, I'd like to ask you to subscribe and leave me a like. It does help me a lot in growing my channel. With that said, now let's get back to the video. Risk tolerance sounds technical, but it's really about one thing. How much emotional pain can you take before you panic and sell your investments? A lot of people think that they're risk averse, but most of the time, what they really are is uninformed. That was me for years. I thought that the market was a one ticket to losing all my money. The problem with that, I had never spent 10 minutes of my life studying personal finance. When you don't understand what you're investing in, every dip feels like a disaster. But when you do understand it, the same dip becomes an opportunity. It's not that you hate risk. You just hate the idea of losing money in something that you really don't understand. Here's the cool part. Once people start to really learn about money and investing, their fears usually shrinks. Think about it. If all you know about the stock market comes from headlines like $300 billion wiped out in a single day, of course you will want to stay out. But when you learn that the market has always recovered from every single crash in history, when you understand what a company actually is, not a ticker symbol, but a real business solving real problems, you stop seeing dips as danger. You start seeing them as discounts for you to buy into the business at lower prices. Financial education is the difference between gambling and planting seeds for the future. Not all purchases in the market are really an investment, especially when you're counting on making a quick profit out of whatever news you've heard. One of the biggest myths in investing is that volatility equals risk. It does not. Volatility is just price movement. It goes up, it goes down, it's loud, it's messy. But risk is permanent loss. And that usually only happens when people panic and sell low. Here's what most people don't realize. Stock prices don't just move because of company performance. They move based on what people think is about to happen. Market crashes often reflect human emotion, fear, uncertainty, not actual business fundamentals. You could own shares in a rock-solid company with billions in revenue, and the price still drops 20% because people feel nervous. But the business itself is still doing its thing. Let's say you invested $10,000 into the S&P 500 30 years ago and just let it sit. You didn't sell during the dot-com bust. You didn't panic during the 2008 crash. You didn't even flinch during COVID. That $10,000 would be worth over $100,000 today. The people who panic sold when things felt scary, they didn't just lose money, they lost time. And time is the one thing that makes compounding work. The longer you stay invested, the more the market rewards you for your patience. But the price of that reward, it's watching your portfolio drop by 10%, 20%, sometimes even 40%, and doing, well, nothing. Now, let's talk about financial advisors. Not all of them are bad, but most are not paid to make you rich. They're paid to keep your money with their firm. Think about it. Their job is to make sure they keep earning fees. They tell you to diversify, stay conservative, avoid risky growth funds, because if you panic and withdraw, they lose income. That's not necessarily malicious, but it means your goals are not always their priority. Today, you can learn the basics on investing on your own via books, podcasts, online courses, and videos like this one you're watching right now. That's how I learned. You can buy diversified ETFs with almost no fees, and you definitely don't need a middleman to hold your hand if you're willing to educate yourself. If you want to be a long-term investor, you have to tune out the noise. And that means ignoring most of what the media says. The media doesn't care about your retirement portfolio. They care about engagement. And nothing drives clicks like panic. Every market drop becomes a bloodbath. Every bump becomes a surge. Their job is to make sure you're watching, not that you're making smart decisions. If you're checking financial news daily, You're training your brain to react emotionally, and emotional investing leads to bad decisions. So what do you do when everyone's panicking? It's quite simple. You remind yourself you're not investing in a chart, you're investing in businesses. You hold companies that make real products, employ real people, and solve real problems. And if nothing about that changes, the price drop is just noise. Have a written plan. Automate your investments so you dollar cost average into your stock purchases on every paycheck you get. This is like paying yourself first. Once you start, don't go looking at your portfolio daily like many do. Instead, do quarterly reviews. And even then, avoid tinkering with it. The more you touch on your investments, the more you're likely to lose money. When the world's screaming, sell, you calmly say, no thank you, I'll hold. Okay, so let's recap. Risk tolerance is about education, not just emotion. Volatility is normal. Panic is optional. Holding long term is the real superpower. Most financial advisors are not looking out for you the way you will. The media, ignore it. And when the market looks like it's burning, zoom out. Just stay calm. That was it for today. Thank you all for watching. And if you want to know more about the ins and outs of compound interest and how it will make you richer than ever, then watch this video next.